If you are listening to this, you are likely approaching the most dangerous financial window of your life. I am not talking about a market crash or a recession. I am talking about a structural misalignment in your own portfolio. For the last 30 or 40 years, you have been a builder, an accumulator. You have been trained to chase growth. You have been told that risk is the price of admission for returns. And for the accumulation phase of your life, that was largely true. But the day you retire, the physics of your money changes completely. I have spent 4 decades managing capital for the largest institutions in the world: pension fund managers, sovereign wealth directors, family offices that manage multi-generational fortunes. We do not think about getting rich. We think about solvency, liability matching, the permanence of capital. Most individual investors walk into retirement with the exact same portfolio they used to build their wealth, holding assets designed for a 20-year horizon, not for immediate income stability. This is a mistake that destroys retirements. I saw it destroy lives in 2000. I watched it liquidate entire family fortunes in 2008. The mistake is simple. You are holding assets that carry risks you can no longer afford to take. Assets that look good on a balance sheet but are toxic for cash flow. Today I am going to walk you through the 5 specific asset classes you must evaluate and in most cases sell or significantly reduce before you retire. This is not about timing the market. This is about structural hygiene. If you enter retirement holding these 5 assets, you are exposing your life's work to forces that can wipe you out in under 5 years. Before we discuss what to sell, you need to understand the perspective I am speaking from. When you manage a pension fund for 100,000 retirees, you have liabilities to pay every single month. If the market drops 30% and stays down for 3 years, a young investor simply waits. A retiree must sell depreciated assets to pay for groceries and health care. This is sequence of returns risk. When you get your returns matters just as much as what the returns are. If you retire and the market drops 20% in your first year and you are forced to withdraw 5% to live, you are digging a hole you will never climb out of. Your portfolio is not a scoreboard. It is a utility. It must produce reliable inflation-adjusted cash flow for 30 years. You must ruthlessly cull assets that do not serve this purpose. Asset class number 1, the illiquid opportunity. The first asset is the illiquid alternative investment, the private equity deal, the angel investment in a startup, the raw land, the non-traded REITs with strict lockup periods. In your working years, illiquidity was a feature. It allowed you to capture extra returns. But in retirement, liquidity is oxygen. I have seen scenarios in 2008 where high net worth individuals had millions on paper, but the market froze. When the market freezes, you cannot pay health insurance with a private equity valuation. If you enter retirement with wealth locked in assets, you cannot convert to cash within 2 days. You are taking on unacceptable risk. Life is unpredictable. You may need $50,000 for a medical emergency. If your money is locked in a 7-year private deal, you are helpless. You must begin unwinding these positions 2 to 3 years before you retire. Sell the raw land. Exit the angel investments. You might say, but I am giving up the upside. I will tell you what I tell institutional clients. At this stage, you do not need a lottery ticket. You need a paycheck. When you are retired, you want assets that are liquid instantly. Treasury bonds, blue chip equities, liquid ETFs. If you cannot sell it with a click, ask yourself, can I afford to hold this if the world shuts down for a year? If the answer is no, sell it now. Asset class number 2, the high beta speculative growth stock. These are the companies that make headlines, the disruptors, the unprofitable tech companies. the cryptocurrencies. Stocks that go up 50% in a year and down 40% the next. During your accumulation phase, these assets were your engine. You bought Amazon early. You bought Tesla early. You feel loyalty to these names because they made you rich. But the asset that makes you rich is often an asset that keeps you poor in retirement. Here is the brutal math. If you hold a speculative portfolio and it drops 50%, you need a 100% gain just to get back to even. If you are 35 and working, you have income to buy the dip. If you are 65 and withdrawing money, a 50% drop is a death blow. Say you retire with 1 million in speculative tech stocks. A crash happens. Your portfolio falls to 500,000, but you still need 40,000 a year to live. That withdrawal represents an 8% rate on your remaining balance. You are cannibalizing your principal at an unsustainable rate. Even if the market recovers 5 years later, you will have depleted so much share count that you will never participate in the recovery. For a retiree, we want low volatility. I am not telling you to sell all your stock. Sell the speculative ones. Sell companies that do not make a profit. Sell companies trading at 100 times earnings. Replace them with quality, strong balance sheets, consistent earnings, dividend growth. Companies that sell toothpaste, healthcare, insurance. Boring companies. Boring is beautiful. When you are retired, excitement is expensive. If you wake up and your heart races checking a stock price, you are over-allocated to speculation. Sell it. Asset class number 3, the concentrated stock position. I see this constantly with executives and employees. You worked at a company for 30 years. You accumulated stock options, or you inherited a massive block of stock from your grandfather. You hold it because of taxes, because of loyalty. Concentration is the fastest way to get rich, and the fastest way to stay poor. Let me tell you about Enron employees, Kodak retirees, General Electric loyalists, the most valuable company in the world that then lost 80% of its value. If more than 5 or 10% of your net worth is in a single stock, you are carrying a bomb in your portfolio. I often hear, but the capital gains tax, if I sell, I pay 20% to the government. Let me give you wisdom from 40 years on Wall Street. I would rather pay 20% tax on a profit than take a 100% loss on principal. Do not let the tax tail wag the investment dog. Diversification is the only free lunch in finance. If you hold the S&P 500, one goes bankrupt. You barely notice. If you hold one company and it faces a scandal, your retirement is over. You do not have to sell all at once. Sell covered calls against the position, or set a schedule. Sell 10% every quarter until the position is under 5% of your portfolio. Do not be the retiree who lost everything because they were loyal to a stock ticker. The stock does not know you own it. Treat it as inventory. If the inventory is too heavy, liquidate it. Asset class number 4, the long-duration nominal bond. This is where most retirees get hurt because they think they are being safe. The fourth asset to sell is long-duration nominal bonds. If yields are low and inflation is structural, traditionally the advice was own your age in bonds. If you are 60, have 60% in bonds, but you must understand what a bond is, a promise to pay you a fixed amount in the future. If you buy a 30-year bond, paying 3% and inflation averages 4%, you have guaranteed yourself a loss of purchasing power. You are safely going broke. We are entering an era of structural inflation, deglobalization, decarbonization. Demographics are all inflationary forces. If you hold long-term bonds, you face 2 risks: purchasing power risk. The money you get back buys less, and interest rate risk. If rates rise to fight inflation, the price of your bonds crashes. We saw this in 2022, where safe bond portfolios dropped 15 to 20%. You need fixed income, but you need resilient fixed income. Get out of the long end of the curve. Move to short duration bonds, 1 to 3 years, less sensitive to rate spikes. Look at TIPS, Treasury inflation protected securities. Look at high quality corporate credit with shorter lifespans. Do not blindly buy a total bond market fund. In a rising rate or high inflation environment, long duration bonds are a trap. Cash and short-term bills allow you to reinvest at higher rates if rates go up. Long bonds lock you into a mistake for decades. Asset class number 5, the depreciating lifestyle asset. The fifth asset is not a stock or bond. It is a physical liability that masquerades as an asset, the oversized primary residence or vacation home. You have heard your home is your biggest asset. From a retirement cash flow perspective, your home is a liability. It does not pay you. You pay it. Property taxes, insurance, maintenance, heating, cooling. The number one cause of liquidity stress in retirement is being house poor. A $2 million house and $500,000 in the bank. The house eats 40% of monthly income just to keep the lights on. When you retire, ruthlessly audit your carry costs. If you live in a 4,000 square foot home with 4 empty bedrooms, you are paying to heat air for ghosts. Downsizing is not a failure. It is strategic liberation of capital. Imagine you sell the big house, buy a smaller place and free up $700,000 in equity. That's $700,000 in a conservative portfolio yielding 5%, generates $35,000 a year. Simultaneously, you reduce property taxes and maintenance by $15,000 a year. That is a $50,000 annual swing in your favor. The difference between a stressful retirement and a luxurious one. Do not let your ego keep you in a house that drains your freedom. Now I want to address the psychology because I know what you are feeling. Resistance, anxiety, maybe anger. Why do we hold on to these assets even when logic tells us we should sell? Loss aversion. We hate realizing losses. The endowment effect. We overvalue things simply because we own them. Identity. We tie our self-worth to our investments. You must strip your identity away from your assets. I manage billions of dollars. I have zero emotional attachment to any position. If the data changes, I sell. If the macro environment shifts, I rotate. You must adopt that same mentality. Think about your future self, the version of you at age 80. Will that person care that you held on to a volatile tech stock, hoping for one more double? No. What they will care about is whether they can afford their medications, quality care, their dignity, and independence. Selling these 5 asset classes is not giving up. It is locking in your gains. It is taking your chips off the table while you are still ahead. Let me summarize. We are removing the illiquid traps that lock up capital when you need it most. We are cutting the speculative growth that brings volatility you can no longer afford. We are diversifying away from concentrated positions that expose you to catastrophic risk. We are shortening our bond duration to protect against inflation and rising rates. And we are right-sizing our lifestyle, liberating trapped equity from an oversized home. This is not a portfolio for a 25-year-old trying to get rich. This is a portfolio for someone who has already won. When you make these changes, you will feel something shift. The anxiety will begin to fade. You will stop obsessively checking your account. You will stop caring so much about what the Federal Reserve does next month. Why? Because you will have built a fortress. You will have aligned your assets with your reality. I want you to take action this week. Open your brokerage statements. Look at every single position and ask yourself one question. Does this asset serve my future? Or is it a relic of my past? If it belongs to the past, thank it for what it did and sell it. Retirement is not the end of investing. It is the beginning of the most sophisticated investing challenge of your life. Stewardship. Be a good steward of your capital. Protect it so it can protect you for the next 30 years.